Okay, so we'll have a review of what we have learned in this semester. We go through chapter by chapter. So you will have a brief picture of what we have done in this semester. Well, in our course, we start with the very first chapter of the introduction. In this introduction, firstly, we have a discussion of the reason why we need corporate finance. We say that corporate finance is just an application of finance knowledge in the corporate setting. The corporate finance, the core question that we have is about how we organize a firm, how we arrange the conflicts of interest within the firm, how we invest, and how we ask for external financing of firms. All sorts of questions about the corporate. And at the very first question, we had a discussion about the types of forms, or the forms of firms. For example, if you are the sole owner of a firm, you want to run a small business like grocery, you can have a sole business. And if you have some friends who want to join together to run a big program, we say maybe a local supermarket. It's not a supermarket chain, but the only supermarket around your community. And you know that the investment for such supermarket can be very large sometimes, so you cannot afford that by yourself. So you ask for some friends who have the same interests to join together. And this kind of firm is called partnership. We have a lot of partnership firms in nowadays. For example, the accounting firms or the law agency firms, they're all partnerships. As partner, you have the right to vote but you have to bear unlimited liability. That is, if the firm is now in the difficulty to repay all his or her loans or debts, as a partner, you have the obligation to repay the money with your personal wealth, and there's no limit. And then we have some limited liability companies. That is, in law, the company will be treated like a human being as well. And now the separation between your personal wealth and the firm. If the firm go bankruptcy, you do not have to sacrifice your own personal wealth to pay all the money back. You don't have to. So this is called limited liability, or we call that corporations. And with the growing number of corporations, we can trade the ownership in the market with an exchange. And by doing so, we call that listed firms, because all these firms are now listed in the exchange. Everyone can buy and sell the ownerships. We call them shares or stocks. So this is the type of forms. And we link that kind of forms with the purpose of corporate finance. So what is the purpose of corporate finance? Alternatively, we say the purpose of corporate finance is to maximize the wealth of shareholders. But this is not true for a small firm because there's no shareholder. There's only one boss. So at this time, you find maximizing the personal wealth of the owner is the same as the maximizing of the firm value, because all the firm value goes through to the personal wealth of the owner. And for partnership, it's the same as well. But there might be some small conflicts there. And for listed firms, things can be very complicated because we have thousands or tens of thousands of shareholders or even more. And how can we make sure that we can make diligence in the efficient manner? Right, we need some specific mechanisms of doing that. And one way of doing that is called the boardings or the board of directors. Board of directors is that we ask some large shareholders to sit on board so they can make some collective decisions on what we should do and what they can do and what they cannot do. And the board stands for all the shareholders. So we call that board of directors. They're just the representatives. Given the very complicated system, we now came across a very interesting topic. That is the ownership and the control rights. Sometimes you will find that there might be some conflict of interest among different parties. For example, here in this class, I, who am the lecturer of the course, is now having conflict of interest with you all. Because I want a final examination that can really evaluate your final performance. Trying to know your strengths and your weak points so I can improve my teaching later in other years. But for you, you want a very high score. You need some ease to pass. So you would like to get something that is easy to go. So now we have a conflict. It's the same in the firm as well. For the firm's owners and the management team can have different perspective about future. If you're an owner of the firm, you're likely to have some dream of running your firm for hundreds of years and tends to be bigger and bigger, or even a very famous brand in the world or in the industry. But for the management team, however, they do not have this kind of dream at all. Because all they care about is the personal wealth, is about the job security, because they have some contracts with the firm, maybe 5 years or 10 years, and they have some targets saying that in 5 years you have to make the firm grow bigger, and the ROA, ROE must exceed a certain number that we specify in the contract. By doing so, there might be some conflict of interest between the management and the shareholders. We call this kind of conflict as agency problems. If we cannot solve the agency problem well, the owners would like to get the firm as a long-term growth firm with very strong demands of making a famous brand. But for the management, however, they care about the job security, they care about the personal return by doing the jobs, they care about the perks, saying that whether they can have some luxury cars, very good housing during their employment. So you can see that things can go wrong when the conflict becomes very severe. But what we can do then? We need a mechanism to align the interests among different parties. We call this mechanism as corporate governance. We did not have very much discussion about the corporate governance in this term because the term is very short. The original understanding of corporate finance is that it is just a designing a mechanism to align interests among different parties. One example is that they try to bind the job security of the management or the personal wealth to the long-term perspective of the firm, even after their retirement or their leaving. But how can they do it? An example is that they can try to set up a very complicated, we say, compensation package. They will receive some fundamental payments for their works, and they'll have some bonuses in case they did very well. And they will have some options and shares so that they can enjoy the perspective of the firm even they have left for a few years. Because if the firm can grow up very well in a long time, the stock price can go up and the options can have a very good value, right? So this is called corporate governance. We have a simple example here. And also, we had a discussion of different roles in the firm, which is CEO, CFO, sort of things. Right. That's all about it. And as for stock markets, there'll be primary and secondary markets, which we have discussed later. For the primary market, it's just so we say when the firm have an IPO, they will sell the shares to finance firms. Financial firm, they will do that on the primary market. But for anyone else, we say, for example, if we buy and sell the stocks in the market, we are now in the secondary market, not the primary market. So always remember that the primary market is participated by the firm itself and with some institutional investors. And for the majority or for the major participants in this market who are willing to buy or sell the stocks, they are in the secondary market. And in the second chapter, oh sorry, we just skip it. Second chapter is about the financial statement analysis. You have another course next semester. And then in chapter 3, we have some value decisions. We have the rule called the one price rule, which is very theoretical. And for the when we're valuing the when we have a decision to make about the project, we say investment. All we care about is the balance between cost and benefit. So we have a methodology called NPV. NPV is the abbreviation of net present value. That is all the sums of the future income. I mean, the present value of all future income minus the initial investment. We call that NPV. We only invest in the program that provide us positive NPV. Positive NPV means that the benefit we will receive by investing our money in that project goes exceed with the initial investment. So it's beneficial, it's profitable. Otherwise, we do not take it. And the division of the NPV including two parts. One is the actual numbers of the future income, and the other is the required return in mind. And the required return is linked to the risk profile of the project. If we find the project is highly sensitive to the market, or say is highly risky, we have a high level of required return of that project. However, if we find that project is very safe, the performance is very stable, and it's nearly unaffected by nearly all the risk factors in the market, we will have a very low required return towards that kind of project. It's natural, right? And as for the law of one price, it refers to the no arbitrage theory. No arbitrage theory means that for the same product. No matter where you sell or buy it, they always have the same price. Because without this assumption, you can never have a chance to say something like one price law. It's impossible. Still remember that I had a joke with you that several hundred years ago, when the Europeans have a strong preference of sending up ships to Japan, purchasing gold in the local market and then send it back to Europe. This is called arbitrage because they find the pricing of gold at the time in Japan was much cheaper than that in Europe. So they can buy in the gold in Japan with very low price, then ship that back to Europe and sell that with a high price. The way of doing this kind of business is called arbitrage. In fact, even nowadays, the market is efficient when we have very strong information flows for all the factors. We still have some arbitrage opportunity in reality. So you might know something called quant trading or quantitative trading. The core of quantitative trading is to find the arbitrage opportunity, even though that only exists in 1 or 2 seconds. Okay. So now we now get into part 2. Part 2 is about the time value of money. The reason why we need time value of money is that the value of money can travel with time. Or people say, well, what do you mean by it? That means for the same amount of money, we say $100 now, and 1 year later, the value can be different. So why will you find that the value can be different? It is because if you retain the money now till 1 year later, and during the 1 year period you can never use the money, you sacrifice the enjoyment that can be brought to you by the $100 if you do not have to follow the kind of restriction. So the value of $100 now includes the enjoyment of $100 later and the sacrifice of your enjoyment in this year. And we call the sacrifice of your enjoyment with a technical term interest. So you have to pay interest for the money that you occupied. It's just because once you occupy the money, someone else will have to sacrifice the enjoyment brought by that kind of money, and you have to pay, right? In the fair market, you have to pay for anything that any other sacrifice. So that is why we have the time value. So the very fundamental concept of time value is that make sure money at different times can mean different value. So you can never directly compare with the $100 today to the same amount of money 1 year or 2 years later. It's impossible. How can we make that comparable? We transform that. We transform the $100 next year to that of current year. So we can also transfer the $100 today to that one of a year later. Now we have a problem. How can we define the equivalent amount of money now to the $100 1 year or 2 years later? And how can we define the equivalent amount of money of $100 now to the period of, say, 1 or 2 years later? We have 2 terms to describe this. One is the present value, The other is the future value. The present value means that how much does it worth for all the future incomes. For example, we convert the $100 1 or 2 years later back to now, and that amount is called the present value of $100 1 or 2 years later. And we also have we also can work at things in another round. We say if we decide to know how much can it worth 1 year later if we have $100 now in pocket. Well, for the equivalent amount of money that can in 1 or 2 years for the $100 now, we call that future value. So try to familiarize yourself with the calculations or the ways to transform among the present value, future value, because that'll be very important in this course later. Now, when calculating the present values or future values, we deal with a stream of cash flows, right? And what are kind of stream of cash flows? Let's see. I will show you something that might be helpful. 1 second, please. Well, when dealing with that kind of calculation of values, we find it very complicated, right? So that is why we will need to simplify the modules. Okay, here is the fundamental exercise for you. Make sure you can work that out. And then we have some formulas here. Unfortunately, I forget about the sheet on the formula sheet on the final paper, but don't worry. I will send you a piece of this if you need that. You know, but I suppose we don't need that anymore, indeed. We say we have a natural form of present value by doing this, but this is very difficult to calculate unless you have a very professional calculator, which can charge you, we say, over 400 or 500 RMBs, or maybe $60 or $80 for the specified, specially designed calculator for the financial analysts. If you want to join the CFA examinations, you will need that later, but not in this course. So the natural way of doing that is we simplify the model by setting all the cash flows in each year are equal. By doing so, we now have a simplified stream of cash flows, so we can do some rearrangements and calculations and find this. And this is the calculation that we will have for the equivalent cash flow in each year for several periods. But and we call this part at the discount factor. But you'll find that even this is very complicated, so we try to enlarge the m period into some number of infinite. Infinite means, in mathematical terms, means that any number is slightly larger than the large number that you expect. Well, that's very mathematical. So by doing this, we have a limit of that we call a C divided by R. R is the required return in your mind. So this is simplified form. You'll find this form very useful later in the valuation of bonds and shares. And if we find the cash flow not have a growth, not C for any periods, but have a small growth rate of G, you find finally the stream cash flow for infinite periods with some growth rate of G can happen value of C1 scaled by R minus G. Remember that we have two terms that must be remembered. One is that G is always lower than R. Otherwise, this formula does not converge. And the other is that C1. You can remember that C0 times 1 and G or C1, but never use C0 here. It's a very common mistake that you can see in final papers, no matter whether you're in China or in UK. In the past 10 years, I have seen a lot of mistakes like this. So be cautious about it. So this is about time value. And then we have a discussion about the interest rates. The interest rate itself is very common to see in daily lives. When you go to the bank to deposit money there, they'll pay you the interest. And if you decide to borrow some money from the banks or from any other financial firms doing that kind of business, you have to pay. And the interest rate is we say, varies greatly. It can be very large, it can be very small sometimes. So when dealing with the interest rate, we have two forms of rates. One is the EAR, the other is the APR. APR is very common to see on the ads or on the materials sent by the banks. This is because APR had a very strong advantage when we try to separate that into different smaller periods. For example, if we have a 6% APR for the project, and you want to know how much interest you can earn in 1 month, or in 3 months, a quarter, or in 6 months in the same year. This can be very simple, because if you want to convert the APR into a monthly rate, you scale that by 12. And for EARs, however, things are more complicated. EAR referring to the efficient annual rate. That means the actual number the actual rate of interest you have to pay or receive. Naturally, we say if the interest is accumulated for 1 year only, in the annual period, you find under this situation, APR equals to EAR. But if you find that the interest is not accumulated, we say more than once in a year. For example, the interest rate is accumulated for each 6 months, or each 3 months, or each month, or even on a daily basis. You'll find that with the increase of the frequency of accumulation, the gaps between EAR and APR are now enlarged. And then definitely, the more frequency they have of accumulation, the higher EAR they will enjoy comparing with the APR printed on paper. So always be careful about EARs and APRs. And for some very small projects, we say the payday loans or small amount of borrowing that we say in Chinese, the tricks they play in the gap between EAR and APR. For example, if they require you to pay back the money with the interest of 1% in a month or in 2 weeks, you will find it's not a big number, right? Because only 1%. However, if you accumulate the 1% into several rounds and compound up to 1 year, sometimes you will find that it can be very, very high. And this is why quite a few guys just dropped in that trap. But be cautious about it. And then we had a discussion about the determinants of the interest rates. We mainly had discussion. We have a discussion about that relation to the inflation and to the growth of the purchasing power. And we find that the actual interest is now comprised into two parts. One is the actual rate, and the other is the inflation. By combining these two together, we call that the nominal interest. And then we had a discussion about the macroeconomic impacts on the interest rate. We have a curve, we call that the YTM curve. YTM curve is just yield to maturity. Yield to maturity is just another name of interest rate in the setting of bonds. And we find that when the economy goes very well in the booming period, everyone enjoys their lives. We have an upward YTM curve, right, in the period. That is the longer or the duration you have, the higher rate you have. And you will ask me a question that why we have a higher rate for the long-term borrowing rather than rolling the 1 year projects again and again for different times. This is because that for one-time long-term borrowing or lending, the borrower will bear much more credit risks than the rolling over basis. Because if you as a borrower, as a borrower, do not have sufficient credit, or you're not reliable anymore, the lender can just terminate the plan and reject to roll over the current plan to protect themselves. However, if the lender decides to lend you money in a very long period, say 10 years, and your credit records becomes worse for the fifth year, and there's very little thing that the lender can do to protect themselves. So that is why they charge a higher rate, €10, as a compensation to the credit risks that they are exposed to. But when the economy goes bad, and you will find the demand of money in short period is really high, but the demand of money in longer duration is low because there's no investment opportunity in this market, and there's no need of long-term money resources, but only short-term loans to make sure they can fill the gaps. By doing this, you will see you see something very curious. I mean the YTM curve. You will see that the short term goes very high, but the longer term remains unchanged. And now you have a reversed YTM curve or yield curve. So sometimes we say that a negative, so not negative, reversed yield curve can indicate some signals about the worsened macroeconomic conditions, or with some joke we say, well, man, the winter is not coming, when you see a reversed YTM curve. So this is about the interest rate. And then in chapter 6, we had a discussion about the bonds. And you find the value in bond is very simple, because the bond is just the same as what we have done in chapter 2 or chapter 3 about the time values. Because as a bond, they have specified their face value or par value. They have the fixed coupon rates, and they have their maturity. Maturity means how many years you will have to wait to get the money back. And the only thing that can be changed, or the only variable in this model, is the required return, or the market return. So you will see that when the market return changes, or the market condition changes, there'll be a fluctuation of the bond prices that can go up and down sometimes. And some students find it very, very difficult to remember the details. Don't worry. So my trick is that you always remember that the bond is like a piece of paper. On a piece of paper, you print the par value or the face value. And then you print out the maturity, the coupon rates in very different corners. And our common sense told us that once something is now printed on a piece of paper, it is not very easy to change unless you print another one, right? So accordingly, the par value, the coupon rate, the maturity are unchanged because they all appear on another piece of paper. And the only thing that is not available on another piece of paper is the market rate, right? So that is about the bond pricing. So we have different calculations, and you have to understand that how the interest rate change can really impact the bond prices. And we also have some discussions about the yield curve. The reason why we care about the yield curve is that the yield is indeed the rate, or the market rate. Given the price of the bond price, given the coupon rates, given the par value, given maturity, and you can solve out the discount rate, which in the setting of bond is called yield to maturity. Now you can plot the yield to maturity of bonds with different maturities or different conditions into a diagram. Now you have the YTM. And we have some discussions about corporate bonds, treasury bonds, and you will know that the bond can be rated by some third-party agencies. And the agencies care about the issuer's solvency, or namely, the issuer's ability to repay the money or to get the money back on time. For some bonds with very high ratings like AAA or AAB, that means they can have a very low probability of default. That is, if you now invest in the bonds with high ratings like AAAs, your money will comparably be safe. However, for some skyrockets, sky finance in the capital market, They always pursue some high returns combining with some risks. For this strategy, they will focus on the other called junk bonds, or we have a literary name for that. We call that high yield bonds. The reason why the issuers are willing to issue some bonds with high yield is because of their shortage or their weakness on repaying the monies. Okay, so last week we had a discussion about how we value the project. Right? Still remember? We spent about 30 minutes of dealing with that. For the project, again, let's have a review. We evaluate the possibility of investing or not investing in the project is based on the principle of cost and benefit. And the cost we say is defined as the initial investment, and the benefit means all future incomes once we invest in the project. However, as we have discussed in earlier chapters, that the money can have time value. That is, we cannot directly compare the future incomes with the initial investment now because they are priced in very different time periods. So the very first thing we need to do is to make sure that they are now all these numbers are on the same basis to compare with. But how can we make it then? Convert the all future incomes into the time zero, and we call that the present value of all future incomes. We sum all the present value of future incomes up, then deducted by the initial investment. If we find the outcome or the NPV is positive, that means we can now do that. Otherwise, forget about it. But the NPV is very complicated to use because it comes with some consideration on time values. And also, for anyone who are working in the bond industry and they care about returns or the rates rather than the actual numbers, we have an alternative form of NPV. We call it ERR or IRR. IRR means internal rate of return that is calculated by letting NPV equals zero. Assuming all the future incomes are decided and the initial investment is decided, we solve the equation and get the discount rate. We call the discount rate at IRR. So if the required return in my mind is higher than IRR, we should reject the project. Otherwise, we accept it. Now, the problem is why? Why we reject the project when we find that the required return in my mind is higher than IRR? Well, work that out yourself. Well, but sometimes IRRs can conflict with NPV because IRR requires that the curve is single and that only one crossing between the curve and the x-axis or horizon axis. But if we have different signs in future outcome, for example, when we run a business, we find that some years we have reported earnings, but sometimes not. And this is the differentiated signs in future cash flows can result in some complex curves of IRRs. That is, the IRR the NPV curve can cross the x-axis in several times, and that means now the equation of IRR found with more than one root. So which one can you prefer? I don't know. So under this occasion, NPV is indeed the safest way of dealing with that. Okay. So this is the NPV and the IRR. But we have some very simple ways of dealing of evaluating the project as well. One way we can do that is called the payback period. Payback period means that we do not care about the time value. We only care about one simple question, that is, in how many years can we get the investment back? This is a very common procedure or a very common methodology to evaluate the business in daily lives. If you have some friends or some relatives running business and they did not receive very formal education in finance, you always hear about the word like this. Well, in 2 years or in 3 years, I can get the money back. Right. This is just called payback period. And sometimes we have problems saying that we may have some mutually exclusive projects. For example, we have jokes that you might have several girlfriends. I personally go against this kind of behavior. Anyway, let's assume it. But you can only pick one up to marry because this is restricted by the law, right? So by doing so, we call that exclusive. For example, now you have a decision whether you should enjoy the spaghetti or fried chicken for your lunch. It's mutually exclusive, right? Because very few guys can really have a very big plate of spaghetti and then a whole box of fried chicken. I suppose if you do that like this for lunch, in 3 years, that a man can become a basketball, getting too fat, right? But for other projects, however, it's not mutually exclusive. In fact, they have the chance to invest in more than one project, and the only restriction they have is the money that they can have in their pocket. So by doing this, we sort these projects in accordance with NPV from the highest to the lowest. We compare with the money here available in the pocket. We invest as many projects as possible, right? So this is the next strategy for investments when we have some do not have mutually exclusive items to pick up. Well, I find a review is also very tired anyway. Now we have a discussion about the forecasts. I suppose the only thing I have discussed here is about the comparable firms, right? So we can use the value. We use the max value of other firms to compare with to have a chance to get to know what we can do. We'll have a review on the slides. Then we have a very important topic about risks. And risks means the calculated uncertainties in the finance world. And I simplify the chapter here, trying to avoid all the mathematics here. So remember that. So you won't be struggled with the equations, formulas here in this chapter. But always remember that risk means uncertainty, and high uncertainty can mean very high required return. And we have two types of risks here, like one is called firm specific risk, and the other is called, we say, systematic risks. The reason why we care about systematic risks and the firm specific risks is that we can try to diversify the risks by forming up some risk portfolios. Risk portfolios means that you have a bag or basket. You can put different kinds of stocks or the instruments into that basket. And because of the different levels of risks, the overall risk can be lower than expected, right? While maintaining a certain level of return. And this is about the rationale of investments. So investment is indeed about science. It's not about jokes. Okay. Now, given that in theory, all the firm-specific risks can be hedged fully with very low or no cost at all. The CAPM, very commonly used in modeling for pricing risks, but focus on systematic risk only, right? But what is systematic then? Even different firms can have very different systematic risks because their sensitivity to the market volatility is different. It's just like the persons, right? And the humanities. Some boys and girls are very sensitive to the climate change. They feel very happy when the sun shines, and they feel very lonely when it's a rainy day. But for the others, like me, I do not care about the the climate, because I always stay in my office or in my house, eating, sleeping, playing PC games, no matter whether there's sunshine or it's raining heavily outside. It's the same for the firms. Some firms have very strong sensitivity towards the market risk. So they have a higher beta coefficient than the others who do not have that kind of sensitivity. Have a review of CAPM and the data and the beta coefficient if you do not understand what I'm talking about. And we had the discussions about the exchange line and about the CAPMs. We did that very simple, so don't worry about it. And also, when the firms are trying to finance themselves by incorporating some outside funding sources, we have two different forms. We can do that by the equity, or we call it investments from our side, or by the borrowings. We mean the debt. And definitely the debt and the equity can come with different costs. And if we if we calculate the total cost of capital of a firm by using some weights, which means that the portions of capital from the equity or from debt. We call that WACC. You will use that in industry fully. And by the way, we have some discussions about the MM theory, right? MM theory comes into two parts. One is that the capital structure is irrelevant to the firm value, because on the ideal environment, the firm can choose to borrow the money by themselves, or the owner can do that at his own hands. When the owner decides to borrow the money on her side rather than the firm, we call that homemade leverage. In the ideal environment, when the home market is fully transparent, there's been no difference on the cost of borrowing between the firm and the individual. So there'll be no impact on the firm value, or the wealth of the owner. And it is the same for the dividend policy as well. Dividend policy means the policy that the firm decides whether or not to pay their dividends, a small fraction of the earnings, to their shareholders. And also, if they decide to distribute, how much would they like to pay? And the other part of the MM theory indicates that there have been no relation between the dividend policy and the firm value. This is because once the investors receive their dividends, they will do their own investments. And in ideal environment, the rate that they can have on the individual investment is the same as the market, as the firm. So there's no impact on the firm value. However, these two theories can only work in the very ideal environment. This is because in reality, we have a market that is not so transparent. We have information asymmetries, and we have selection. Also, we have more hazards, and we have other selections in the market. And for the borrowing and for the investment, firms can also have some very good advantages, partly due to the economy of scales. So in reality, we have some optimal cap structures, we have optimal dividend policies. This is the reason why. By the way, we also have some discussions about the information's role in the capital market, right? And the core idea is that the market movement is triggered by the information available in the market. Way we analyze the role of information is the classification or the assumption of EMH. EMH informing the efficient market hypothesis. That is a very fundamental theory nowadays in contemporary finance, because the efficient market hypothesis means that on the ideal environment, the market is fully efficient. Any news that appear in the market and new resources will have a reflection on the market movements immediately. By immediate reaction, that means there's no private value for any information. However, in reality, you find the market not that transparent, not that efficient. We have some lags, with some delays, and some delays result in value of say private information. So in the years we have a new type of information asymmetry that not discussed several decades ago. That is the information asymmetry between the investors with information advantage and those without. We have some papers on this measure, which is very interesting anyway. There, I suppose we have some valuation of stocks, right? So where did? So we have valuation of stocks. Stocks is very similar to that of bonds, with the exception that bonds shares do not have maturity. So we have infinite periods of yield for them. And the yield in bond here in the setting of shares is now called dividend. Right? So you have a review of how you can value the stocks as well. Now, finally, we have a discussion about the external financings. However, we only have time to cover the equities rather than the debts. So let's see, where is it? Oh yeah, here it is. Well, for some finances, we say in the form of equities, this is very important. But initially, we have very different stages towards that. In the early days, when we do have efficient, we say, financial resources for the operation of a firm or to extend the business, we ask for some external financings. And initially, we ask for angel investors. Because angel investors have very strong preference to invest in some firms with very early stages. And then we say venture capitals. Venture capitals would like to join in a bit later than the angel investors. And also, angel and ventures can have very different rounds, we say round A, B, C, and D's. And with the growing up of firms, and the venture will then welcome the institutional investors. Institutional investors can be some very large firms, some financial firms, and insurance companies. And with all the growing ups of this, on the help of these foundings, the firm now can go listed. The reason why firms are eager to go listed is that because of two reasons. One is that they can have very strong access towards the we say the very large amount of money pool built up by the stock market. The other is that the angels, the ventures, or even institutional investors do need a channel to exit. Selling or selling or the market of private firm ownership is very illiquid. I mean, very few people would like to buy it. But if the firm go listed and the ownership can be transferred now, can be traded in the open market, things are quite different. the angels and the ventures and the institutional investors can have very easy access to sell their ownership to get the money back, so they can have enough money to invest in other products or projects. So this is about financing. Oh, by the way, I missed one thing, that is about the dividend in the impact of dividends. When the firm decides to retain part of their dividend to extend their new business, and we will find that the new business come with a very different rate of return with the traditional business in that firm. So you will have a chance to see a growth of dividend in future because of the investment in some new businesses. There will be an example on a piece on that paid book. You can have a review. Or if you still have any difficulty, we can have a talk next week, because the next week will be as the doubt solving session. So if you have any question, you can just raise to me. We will have a QA for about 2 hours. I suppose that is the main idea of what we have discussed in this semester. I find taking a review can be challenging and can be very tiring. And I have to say that all the question papers are included in my words. But my words come with a larger scale than the paper, because I'm not allowed to tell you what will be appeared in your final piece of paper. And this video, if you agree, will be available on the Bilibili and on YouTube. So, any question for the review?